much. Good afternoon. It's a pleasure to be here. And I enjoyed certainly Professor Heidmann's presentation, who at the very end kicked over the ball to me as an invitation to talk about Europe. I'm happy to do that. But let me also repeat what my colleague Kardinale already said yesterday morning. The ESM is happy to support this conference. We pay a lot of attention to risk management at the ESM. We are still a fairly young institution, so we are still in the process of building up our risk management capacity. But you will see in the next panel we have our Chief Risk Officer here and the Deputy Chief Risk Officer, and their team is expanding. So risk management is very important for us. But my job today, particularly after Professor Heidmann's presentation, will talk about Europe, more the policy world, the public sector. But I think you will see that there are many links. And I must say, his presentation did not leave me less worried than I was before. I share his views basically. I was also skeptical already in 2006 and 2007 about what was going on, not from an academic perspective, but being in the policy world. And I was worried that risks were building up in bubbles. I think, and I've said this often to my staff, it feels like we are now on the great moderation number 2. And we know how great moderation number 1 ended. The good news about Europe, and I was encouraged that Professor Heidmann said Europe is in certain respect in a better situation than the United States. And I want to explain to you that also in the areas that I deal with on a daily basis, we have done so many things the last 5 years since we got into our own crisis, that in overall perspective we are less vulnerable today than we were 5 years ago. And I think it's important to remember then that when the global financial crisis hit, particularly after Lehman in September 2008, and the entire world was affected by that, that was a real global crisis. At the same time, Europe had its second crisis. And that's also the main explanation why we, in the end, then had a very serious crisis, the worst in 80 years. It was a combination of these two shocks, the one that was triggered in the United States and our own homegrown European crisis after the first decade of monetary union. But a lot has happened since 2009. In response to this crisis, we have done many things, and that's really what I want to talk about. First, I will say a few words of what went wrong in Europe. So the second shock, not the first global shock that hit everybody, but the second shock. Then I will talk about the main lessons we have drawn from the crisis and what we have done in response. And then I will conclude. And after that, we are both happy to take your questions. So what went wrong in the euro area? We saw during the first decade of monetary union that many imbalances were building up slowly inside the monetary union. Particularly the 5 countries that later on received emergency financing from my institutions. This is Portugal, Cyprus, Spain, Ireland, and Greece. These 5 countries were building up more imbalances than anybody else. There was financial fragmentation. You see it here in the debt accumulation, which was much higher than in the other countries. So these countries, that's a periphery in terms of public debt, but also private sector debt. And the private sector debt causes together, public and private sector debt accumulation was the other side of the coin of very large current account deficits, which in 2007, 2008 went up to 15 and even 18% of GDP. The other, okay, this is not the latest version. The other, sorry, there should be another slide that shows how the problems also were building up in the public sector. Fiscal deficits became very large in Greece, 6 years ago, 15% of GDP, far above the normal levels. So we had excessive debt and imbalances in a number of countries. Basically, countries were not really living up to the requirements that the monetary union brings. Because a country that joins the monetary union loses certain degrees of freedom. They are no longer sovereign in every respect. Although you hear Mr. Tsipras saying today that Greece is a sovereign country and therefore basically they should do what they want to do. It's just the wrong statement. By joining a monetary union, the country loses sovereignty. The country already loses sovereignty by joining NATO or United Nations because there are certain requirements. Joining the European Union brings more of that, more loss of sovereignty, and the monetary union goes even a step further. And countries were not respecting that. They continued with the same policy approach as before joining monetary union, and therefore they got into this crisis. But as I said, since the crisis broke over the last 5-6 years, many things have happened, and I want to point to 5 main lessons from the euro crisis. The first one is that it's important to reduce vulnerabilities by implementing reforms. So in a broad sense, this is also risk management, if one can reduce vulnerabilities. What have countries done? And again, in my charts, I will mainly show the 5 countries that had to accept adjustment programs in exchange for emergency financing. Here you see how the fiscal balance that had deteriorated earlier, these deficits are shrinking. Germany is shown there as a kind of benchmark for Northern European countries, balanced budget. But all these countries are now moving towards deficits below 3% of GDP as a first step, and then towards a structural balance. That is the agreed objective. And as you know, there's a lot of argument about the speed of this adjustment, and economists can argue about that endlessly. But there's no disagreement about the direction, that all countries should move to a balanced budget in structural terms, which means the automatic stabilizers, of course, should work, but in structural terms or cyclically adjusted terms, there should be a balanced budget. Actually, Europe, also in this respect, is quite advanced compared to the United States, Japan, or the UK, other big economic areas. In the aggregate, the fiscal deficit in the euro area this year is 2% of GDP. You see it on the right-hand side, while in the other regions it's 2 to 3 times as big. Countries have also restored their competitiveness. Another big problem that contributed to the crisis. By 2008, in countries like Greece, Ireland, Portugal, and Spain, the unit labor cost, and I show them here in a cumulative way since the year 2000, unit labor costs had increased by 30 to 40% more than in Northern Europe. That meant that competitiveness had been lost, therefore current account deficits became very large. But the good news is that since 2008-2009, we see a clear turning point. Unit labor costs are falling. They're also now going up in Germany, where the cycle is more advanced and labor market is tight. So the problem is, it's closed from 2 sides. And basically this problem has been corrected. That's real progress. That's also why these countries, like even Greece, have very high growth rates on their exports, and they have balanced current accounts. These 5 countries that had to go through adjustment programs are also making significant progress in structural reforms. Structural reforms is a very broad term. This can deal with labor market reforms, it can deal with opening up of professions, many things, not easy to put them all into one indicator. But there are institutions that try to do that. The Lisbon Council is one, the OECD does it, the World Bank does it, and they all come to the conclusion that, again, these countries that borrowed from EFSF and ESM have put in place more reforms than anybody else. For the World Bank, which is a global institution, obviously, it means these 5 countries have implemented more reforms than any of the other 190 countries of the World Bank. And this shows Greece, all of them show Greece in place 1. I think it's important to remember today, as Greece is moving backwards on reforms, this shows the situation by the end of last year or very early this year. So Greece is now moving backwards, but there was substantial progress also in Greece over the last 2 years until the end of last year. Here, these are the World Bank data. They show quite well, on the one hand, the progress from 2010 to 2015, always early in the year. Greece jumped in this ranking from place 109 to place 61, a jump of 48 places in 5 years, unprecedented in the history of this World Bank indicator. But still, at place 61, Greece is still the weakest country in Europe. So it shows, on the one hand, big progress, on the other hand, that there's still a lot to do, and of course, slippage would not be appropriate. So, but overall, at the country level, the lesson very clear: reduce vulnerabilities by running smaller deficits, trying to reduce the debt, or at least the accumulation of additional debt, implement structural reforms, because that will lead to higher growth in the future. The second lesson is that we have to strengthen the governance of the euro area. Economic policy coordination is key in a monetary union where monetary policy is totally centralized, one interest rate, one exchange rate, but the other policy areas, fiscal policy, economic policy, are conducted at the national level. Many academics, particularly in the Anglo-Saxon world, have always said this can never work. We still believe it can work, but it needs to be coordinated well. And the coordination was not good enough before the crisis. We focused mainly on the fiscal side with the Stability and Growth Pact. This was not wrong. Fiscal spillovers can be very important, but our surveillance, our monitoring, our policy coordination was too narrow. So what have we done the last 5 years? The fiscal surveillance has been tightened. The rules of the Stability Pact are now stricter. There's also less room for political interference. We have a balanced budget and debt rule, also introduced in the national legal system. We have a so-called European semester, all attempts to coordinate better. But importantly, we created also new procedures to capture other developments that can lead to a crisis, as we learned the last few years. So we also monitor now in a systematic and comprehensive way credit developments, bubbles, real estate sector, competitiveness, wage developments, and all of that. And an important last point is here that we have now, for the first time, a system that we can verify data, because Greece was cheating on its fiscal data. Eurostat didn't have the power to go and check. Now Eurostat has that power. So many elements here under the setting of better economic policy coordination, and I think the sum of these different elements is quite substantial. Of course, governance could be strengthened further, and steps are under discussion how to do it. Nothing decided, but I mentioned some of the elements that are under discussion in academic circles, and probably also in the policy world. The presidents of the ECB, the Commission, the Council, and the Euro area are writing a so-called 4 Presidents report that will be published, first given to the summit at the end of this month and then published. And you will find some of these elements also in that report. Doesn't mean that all will be adopted immediately, but at least the discussion has started. You will find there things like a euro area finance minister, not in the sense that the budgets of 19 euro area countries will be put together into one budget. The national finance ministers will continue to exist, but the term euro area finance minister means somebody who is in charge of the overall fiscal policy, who will also remind countries that are moving out of the agreed rules. So somebody with authority who can stop wrong national fiscal policies. What is also under discussion is to create a second budget at the European level. We have an EU budget managed by the European Commission, and we are discussing to have a second budget for the euro area only in order to tackle asymmetric shocks and divergent economic developments. We also want to see more joint decision-making to accelerate the decision on structural reforms, but all this in the end will also mean that we need more democratic accountability and legitimacy. All this is difficult, not easy, but it is possible, also possible without a treaty change, because changing the EU treaty takes a lot of time and is politically risky, because it requires referenda in a number of countries, and we know from experience that that is risky. The third lesson from the crisis is that we needed to strengthen the European banking system. Again, many things have happened in this area. We created already 3 years ago new supervisory authorities for banking, insurances and securities markets. There's the ESRB, European Systemic Risk Board, not well known in the broader public, but with a very important mandate to monitor macro-prudential risks, something that was largely ignored before the crisis. Other countries like the US, UK have also created such a new body with the same mandate to monitor macro-prudential risks. There are financial market reforms going on everywhere. This is not a European issue. It's happening globally. In Basel, with the G20 Financial Stability Board, but of course Europe plays an important role in this global work. In the context of financial market reform, EU banks have added 560 billion euro to their capital since 2008. This is an enormous number and means basically a doubling of the capital of EU banks, and obviously that makes them safer and less likely to require public funds in the future. Then looking at banks in Europe, you're all aware that the banking union started last November with the ECB acting as a single supervisor for the 130 systemically relevant banks. We have a new bank resolution regime with the Bank Recovery and Resolution Directive, which will become fully effective early next year. And this new directive creates a uniform framework for bank recovery. And the most important innovation is that bailing in of bank creditors will always be a precondition before any public money can be made available. In the context of the banking union, we also created a new single resolution mechanism and a single resolution fund that's being built up over 8 years. The contribution from my institution, the ESM, to the banking union is that we created a new instrument. Our traditional instruments, I come to that in a moment, are loans to governments. But we now also have a new instrument to take capital in a bank. We call it direct recapitalization instrument. It has not been used. It's not likely to be used anytime soon, but we have it in case of the crisis. And that's good to have on the shelf. The fourth lesson from the euro crisis is that monetary policy must play a very active role. As Professor Altman said, the ECB has been more cautious than the Federal Reserve. I think partly because of the concerns that he expressed, because very active monetary policy, low interest rates for very long, QE, all this is really needed in a crisis, and nobody questions that the Federal Reserve was right to do all this in 2008, 9 and 10. But the questions come when this lasts for very long, because then the unintended consequences that you talked about, creating bubbles, misallocation of resources, that will increase. So while the marginal benefits of QE, let's say, decrease over time, the marginal cost will increase over time. In Europe, I think we are very well aware of this. The BIS is the only international institution that writes about this extensively, and you must have a lot of sympathy for that institution. In the US, it's not quite as developed. But I think the ECB has demonstrated that they are up to the task in a crisis. I put here all the different programs and initiatives on the slides that they introduced over the years, buying in the secondary market, giving unlimited liquidity to banks, OMT, outright monetary transactions, announced into September 2012, which was the idea to combine an ESM program which provides conditionality with the unlimited firepower of the ECB. This was very important to calm markets in September 2012. Today, by the way, the European Court of Justice came out with a ruling that this OMT is legal, because there was a case brought by the German Constitutional Court. Well, Germans went to the German Constitutional Court and they gave the case to the European Constitutional Court, and the ruling came today. So OMT is okay, it can be used in the future. Most recently, the ECB also announced to do quantitative easing since March this year, and probably till September next year, they buy 60 billion euro every month from the markets. So this is everything the ECB has done, and again one can argue whether we are now getting to the end of the crisis and there is enough of exceptional monetary measures, but at the peak of the crisis some of this is absolutely unavoidable. And that takes me to the fifth point, looking at the 5 lessons from the euro crisis. It deals with the creation of the crisis mechanism. The two institutions that I manage, the EMSF and the ESM, they did not exist before the crisis. The founding fathers of the euro could not imagine that a member state of the euro area could lose market access. This was unimaginable. I could also not imagine this when we prepared for the euro in the 90s. Basically, it was not foreseen that a crisis of this magnitude would hit the euro area, the worst crisis in 80 years. So what have we done? 5 years ago, the EMSF was created as a temporary institution. It only was allowed to disperse loans for 3 years. It works under Luxembourg law, which is quite unusual, private commercial law. That was the only way to set it up very quickly. The ESM started operations in October 2012. It's a permanent institution. It's an international financial institution working under international law. So for a while, the two institutions will work in parallel. They have the same mission, the same mandates, the same instruments. And the EMSF will be closed down once the loans that the EMSF has given are repaid, and then EMSF bonds are being repaid, and then the EMSF will be closed down while the ESM will continue as a permanent institution. So both institutions have the same instruments. They provide loans, always against conditionality. We never provide financing without conditionality. In that sense, we are very similar to the International Monetary Fund that also provides loans only with conditionality. Where we are completely different from the IMF is that we have to go to the markets to obtain funds first in order to be able to give loans. The IMF gets its free financing from central banks. Basically, it's automatic. We don't have that luxury. We have to go to the markets. That's also why risk management in our institution is a bit more complex than at the IMF. Here you see what we have done the last 4 years. We have given loans to 5 countries. I mentioned them already early on the slides I showed you. The ESF gave loans to Ireland, Portugal and Greece, ESM to Spain and Cyprus. Together, these 2 institutions have a lending capacity of 700 billion euro. We have committed 238 billion euro and dispersed so far 232 billion euro. So that's a lot of money in 4 years and about 3 times as much as the IMF dispersed globally. 3 countries out of these 5 have exited their programs: Spain, Ireland and Portugal. The programs are ongoing for Greece and Cyprus. Greece, you are familiar with all the problems. We are struggling with them. There's 1 disbursement under the current program outstanding. But as I said, we never disperse without conditionality being in place. And conditionality also means we monitor whether the promised reform efforts are undertaken, whether the policy changes are really implemented. And if that is not the case, we do not disperse. That's why the 1 disbursement has been pending now for 10 months. Cyprus is ongoing, but in a positive sense. They are making good progress. They will exit next year. The fact that we have ESF, ESM, I mentioned, very unusual, not anticipated at the outset of monetary union, brings a number of benefits to the euro area. First, of course, with the ESF and ESM, it was possible so far to keep all the countries in the euro area. If the ESF had not been created 5 years ago, Greece is a special case, but even Ireland and Portugal would probably not be in the euro area today. And that would have changed the nature of the euro area and the European Union, and Europe would be a different place today. But on top of that, the ESF and ESM programs promote fiscal adjustment, structural reforms. I showed earlier in the slides that these countries that go through adjustment programs, they obtain financing, but they have to implement conditionality, that they have done more reforms and more adjustment than any other country. And therefore, these countries will do very well in the future. We see it already today. Spain and Ireland have the highest growth rates in the EU, already last year, will be repeated this year. Portugal is also doing very well. And Greece, up to the end of last year, also expected high growth rates for this year and next year, but that may not happen. Through our programs, also we really provide solidarity to the countries that receive our financing, because our financing terms are extremely advantageous. We pass on our own funding costs, which are around 1%, to these countries. We had a very, very small fee to finance our operating costs, but that's small. So for these countries, that means substantial savings. On this, at this table you see how much each of the 5 countries that received financial support from us saved in their 2013 budget. When you look at the line for Greece, the numbers are the biggest because Greece received more money from us than the other 4 countries. Greece in 2013 saved 8.6 billion euro because of our very low financing cost, very low interest rate we charge. Also in Greece, we deferred interest payments for the first 10 years, so it's a real substantial savings. And that's equivalent to 4.7% of Greek GDP. This was 2013, and the number is going up slowly. It's a bit more 2014 and 2015, because we continue to disperse. So this is really the solidarity that the countries receive from the euro area, because sometimes in these countries one hears complaints. We go through all the adjustment. It's painful. Our wages and several pensions are cut. Whereas the solidarity is there indirectly by providing very, very favorable financing terms. One can see it also looking a bit more in detail how different decisions that we took over the years impacted the yield curve for these countries. I picked here two examples. In July 2011, it was decided to extend the average maturity of our lending program to Ireland from 7.5 to 15 years. And you see on the left-hand side how the Irish yield curve reacted to that. After 1 month, after 3 months, in the different maturities, and you see this significant positive impact on yields in the secondary market. So it's not only that our own lending terms are very favorable, but by being generous with our maturities, it also had a positive impact on the private financing for Ireland. And on the right-hand side, you see another example, Portugal, the Portuguese yield curve, how it reacted in March 2013 to the decision to extend maturity from 12 to 20 years. And again, you see a drop in the yield curve, not quite as much, but at that time the general interest rate level had already come down for other reasons. Therefore, the improvement is not quite as sizable as in the Irish case, but still visible. And the important point is that other countries like Italy, nothing happened. So if one takes Italy as a control country, there was no decrease in the yield curve at that period. So I think it's a good example of how our lending terms have in general positive impact. It also led the same episode to a reduction in the bid-ask spreads, so indicating that liquidity was positively impacted. And all this, of course, in the end has an impact on private markets when they assess whether they want to go back to these countries or not. They decide to go back. These countries by now, as I mentioned, have exited their programs. They have no problem refinancing themselves in the private market at very reasonable interest rates. So that's what I wanted to show, how Europe has done during the last 5 years, what has happened in response to the crisis, mainly geared to our European part of the crisis, which came on top of the global financial shock. And I think it's important that these measures have been adopted because financial instability will always be there. There will always be another crisis one day. It's part of our economic system. It would be an illusion to believe that we can live without crisis. But I think we have reduced our vulnerabilities. The most important point is that member states have really made their own economies stronger through adjusting, which will also lead to stronger growth over time. We have better economic policy coordination in the euro area, which for a well-functioning of the euro area is important. The banking union, the stronger banking system, will also help to contain future banking troubles. I'm not saying will eliminate, but will contain. The ECB has a better improved toolbox to deal with financial stress. And finally, the establishment of the ESM also helps to deal with any future crisis that may come. So I think these are, in the end, also good examples for crisis management at a very global level. That's, I think, why it's linked to the work you do and the other presentations you follow during this conference. Thank you very much, and I'm happy to answer your questions.